Okay, so let's get the briefing underway here. Final sort of final Friday session of the year, really, for markets ahead of the next couple of weeks, disrupted by Christmas and then New Year, of course. So let's just piece through what happened yesterday, because it was a pretty big day, I would say, and I'd say a massive delayed reaction to what happened on Wednesday night. I mean, what we're getting just here this morning, before we talk about yesterday and then look at the day ahead, you're definitely getting some decent dollar strength as well as some euro weakness, and this has triggered a bit of a move, decent move, breakout move higher for the Bund. I mean, the Bund is on fire here. We're at 220 ticks off the Yellen low from Wednesday night. So massive reversal higher, and we're in sight, and it's still going as I'm speaking. 159 handle in sight. I mean, some of these tops from last week, 159.21 last week's high, 159.36 the high from the week before. If we just look on a daily chart, big moves here as we reverse. I guess actually just thinking about it, we're still chopping around in the middle of the very, very large Draghi-induced range set in the first week of the month. So we're kind of back to the midpoint of that range here now. But yeah, certainly some dollar strength. You've got some bond market strength. The equity space is quiet, nothing really happening, and oil's very quiet, but ticking up and trying to test the $35 handle. So some decent amount of action here. And just thinking about the dollar first up, when we talk about yesterday's session, let me bring the dollar index chart in here. This is just a screenshot of the dollar index chart, just looking on a daily time frame back over the last few months, and it's been a massive quarter three really for the dollar, with initially weakness at the beginning of quarter three after the disappointment in the Fed decided to not hike in their September meeting, and then we had a dovish October meeting. By the time we got towards the end of October, we climbed higher. A lot of this was euro weakness, as Draghi promised to deliver. But then, yeah, real big move higher as we got Fed hawkishness, as we got powerful payrolls numbers coming in, and more that December hike got priced in. Then Draghi threw the curveball by not delivering at the start of December, bringing this thing sharply back low. I know this is the dollar index, but it really is the euro dollar, given that the euro makes up, well over 50% of the dollar index basket is the euro. So it really kind of is the euro dollar. But look what happened yesterday. Sharp move higher, and reclaiming now more than half of that Draghi sell-off at the beginning of the month. And so actually for the dollar, believe it or not, this was the second biggest rally, intraday rally for the dollar index the whole year. And why did it happen? Well, it was definitely as I said, a delayed reaction to what happened on Wednesday, when we got a real chop fest. If I come back and we look at the 1 hour candle here of euro dollar, of course, you know this from Wednesday night, it was a real choppy and in the end quite neutral reaction to what happened. But then yesterday we got that move that really markets kind of woke up and I think realized that ultimately we've got 4 hikes next year and we're not priced for it. So we got some dollar strength. This had a big impact on the commodity space. I mean, yesterday's session was definitely all about dollar strength and commodity weakness, and equity weakness, as equities gave back those gains from Wednesday night and indeed Thursday morning that were just a bit weird and not justified. And so when the energy and miners came under pressure again off the back of sharp moves lower for commodities, helped and driven by the dollar strength, well, then the equity space came off. It came off sharply. And in the end, the S&P into the close last night, breaking below Wednesday's low, in a big move to the downside. If you have a look at a daily chart for the S&P, it's 1.5% lower yesterday. Big move, again, coming off this top. We keep setting tops and they keep being lower. I mean, this is definitely if I go to a weekly chart, I guess it's less obvious with what's happened this week, but a pretty remarkable candle for this week. But every time we drive higher, it's a lower high, and then we, fall over and turn lower pretty quickly. So, it's without a doubt 2015, or certainly Q2, Q3, and now Q4 has had a downward trend. It hasn't been a dramatic downward trend. Even though we had a violent move lower in August, we had a phenomenal rebound. It's just that where we rebounded to wasn't the top. And so we do have this downward trend theme for certainly the second half of this year. And it seems to be that is, the market is maintaining that pattern as we go into the year end. So big move lower for equities yesterday, certainly helped along by those miners and those energy stocks. So if we have a look at oil here and just, what happened yesterday was we flirted with, but didn't quite make it down to that low point that we had at the start of the week. 34.53 is the new 7-year low, and we almost got there yesterday. We were just sort of 10 cents off it, and we've been very sideways and flat since. If we go to a daily chart, you'll see it's almost like we'll see where we go today, but I mean, of course, this is, trends don't get as steep as this very often, and key test of that August low midweek, and a key hold, and then a real sharp reversal back to the low. So we're still very much in a downtrend. It's a very steep one. 34.53, very, very important. Okay, low of the week. If that gets breached today, well then $34 will be tested, almost certainly. One thing to note though, on whether or not oil has reached its low, is this the low? Now we got, in my mind, a pretty strong signal that the low is near, and that signal was a reverse indicator called Goldman Sachs. Goldman Sachs yesterday, kind of headline news, Goldman Sachs predict $20. Goldman Sachs think that oil's going to hit $20 in 2016. Now, the reason why I say this is a classic reverse indicator is because they made probably one of the worst calls, well, certainly one of the most memorably bad calls in markets in my career, was in 2008 when oil, and let me just show you on my chart. I don't know if you guys appreciate what 2008. If you think this year's been dramatic, well, it's nothing. It's got nothing on 2008. What easily the most remarkable year ever in the history of oil. At the start of the year, we were trading around about $90. We rallied to 150, and it was at this point in June 2008, as oil was up around 150. Goldman's made, as I said, in my mind, the most memorable bad call in my career, and they said that oil's going to trade to $200. They said oil's going to be at $200 by the end of 2008. Where was it by the end of 2008? 30. It couldn't have been more wrong. Now, I think they're in danger of making, perhaps not quite as equally as bad. I don't think you could possibly get anywhere near the call being that bad ever again. Calling 200 and it actually finishes up at 30. But I think they've made an error. Well, we'll see. Time will tell. But I think as you know, I've been saying, I think the credit crunch lows are probably the $30 handle. I can't, it's just not justified down here. That doesn't mean it can't be down here because of irrationality. I just think it's not justified. And I think that ultimately through 2016, we will see a move higher. It may not be for supply side issues. It might be for demand side issues. Global growth is weak, and I don't think it can be at this weak again in 2016. So maybe it'll be demand side functions that will help stabilize this market. I'm not saying we're going to get a massive rally next year, but I think you can a bounce to $50 or even $60 is certainly carries a lot of potential, and there is a lot of military action going on in the Middle Eastern area, which, you know, at any point could trigger some kind of supply side event as well. But anyway, Goldman's calling $20. So could be the perfect reverse indicator. We shall see. Goldman's have been wrong before. That's all I'm saying. Okay, so looking at today, today's a bit of a write-off from a data point of view. We've already had, well, we've definitely already had the biggest market move of the day, and this came in Japan last night. And this is the dollar yen. I got the spot market here, which is printing it, well, the right way round, the dollar versus the yen. You guys on your CQGs will be charting the yen versus the dollar. But let me just show you what happened last night. Quite extraordinary. We had the Bank of Japan. Well, let me zoom in on a 5-minute chart here. We had the Bank of Japan on the wires, and they delivered more stimulus. Hence the initial reaction. It was a surprise. I mean, as Bill was saying earlier, perhaps people were thinking January was going to be the time where they press the button and deliver more. And so we got a bit of a surprise in that they delivered some more last night. And so you got the yen weakening quite dramatically as they extended their QE program. They've also announced a sort of Operation Twist style policy where they're going to increase the average duration of their balance sheet, implying they're going to be at least buying more on the long end of the curve. I didn't actually get the details. I'm not sure whether they're going to be a proper Operation Twist, what the US did, where they actually sold some of their short duration bonds and then bought long durations with it. But so they're going to be buying more equities basically through ETFs, and they're going to be lengthening the average duration of their balance sheet. So we got initial reactions, which were yen weakness, dramatic yen weakness, and the Nikkei 225, which was in heavily negative territory at the point, rallied strongly. It's just it didn't last.
The upper house of German Parliament passed its 2016 budget. That's the upper house.
It didn't last. Well, it didn't last any time at all, because 10 minutes later the yen was making new highs, and all of those sort of QE moves got reversed, and equities dumped and finished in heavily negative territory. And the reason being, I think, is that ultimately this is a tiny package. They delivered it. Even though it was a surprise, I think the way markets have taken this is, well, hang on a minute. Does this mean we're not going to get any action in January? I think markets have in the end taken it as a little token gesture, a tiny increase. We're talking like 300 billion yen increase, which is, when you do the math, is nothing really in the grand scheme of things. So it's a tiny increase, and I think traders have taken this as, well, actually this probably means there's no chance of a more meaningful extension to the program in January's meeting. So this is probably why we've got these big reversals, and you can still see here the yen still making, well, further gains against the dollar here. That's probably the biggest, most dramatic event. What's happening on the calendar today is nothing. There is no data. I mean, literally no data. So I think it's still going to be a kind of fallout from Wednesday. The commodity space is going to be driving price action, especially, you know, you've got to think about this oil market just clinging on above above Monday's low. If you get a break on oil, that can certainly trigger movement elsewhere across assets. You've got this dollar strength, the euro dollar here testing yesterday's low right now. So if you get any key breaks here, either the euro dollar breaking down to test a 108 handle or oil breaking 34.50, this is what's going to trigger movement everywhere else. Okay, definitely yesterday's session was dominated by dollar strength, commodity weakness that fed into equity weakness. So there's going to be more of that. We're going to need to see some of these key levels broken. It might be a day where things settle down and we get a bit of a rebound on yesterday's moves. It is quadruple witching, so you're going to get more volume in these equity markets. Quadruple witching, where you get the, let's say on the S&P, you're going to get the index futures and the index options expiry, also the single stock futures and the single stock options all expiring, hence the quadruple witching. And this leads to often just more noise more volume, but more noise. This more volume doesn't necessarily bring more momentum. It tends to just bring more noise. So you might see on your ladders quite a bit more what I would call as price action, but don't let that be misleading. You know, don't necessarily see this step up in price action as potentially more momentum. It may well be just a lot more noisy, which can be actually pretty dangerous to navigate through. So just be aware of that. So let's see how we get on. What we also will be doing at 11 a.m. It will be the one of the key events on the calendar for any Amplify trader, and that is the Amplify Christmas quiz. Oh yes, and this will be coming at 11 a.m. This is a quiz on economics and markets. And just to set your expectations, average score for the 2014 quiz, the average score was about 40%. As Will's just said, the prize today is a gold bar. I kid you not. All right, guys, that's at 11 a.m. That's it for the briefing. Thanks.